We've all grown up with the exact same modern myth of wealth creation. To win, you have to lock yourself in a room, outsmart the competition, and invent the next brilliant, world-altering app. Take Daniel. He's ambitious, sharp, and spends his entire savings building a new tech platform. But he is stepping onto a battlefield where thousands of other founders are trying to do the exact same thing at the exact same time. Look at this chart visualizing the one-time sale model. The cost to acquire a new customer demands massive, constant inputs of time and money. Because he only gets paid once per transaction, Daniel has to constantly persuade a brand new group of people just to keep his revenue barely ahead of his expenses. When you operate in a hyper-competitive space that requires endless persuasion, the mathematical odds of survival are low. The failure rate of these exciting innovations usually has nothing to do with effort and everything to do with bad structural math. Now, let's look at the absolute opposite end of the economic spectrum: cleaning commercial windows on a harness, heavy concrete scrubbing, or managing an empty parking lot. These are unglamorous, physically uncomfortable tasks that most educated professionals dismiss entirely. Yet an operator running a modest window washing crew focused entirely on hospitals and corporate offices routinely clears $300,000 a year in pure profit. And they do it without ever strapping on a safety harness or touching a squeegee themselves. They succeed because physical discomfort acts as an invisible shield. When a job looks unappealing or scary, almost nobody wants to do it. That lack of competition means the operator gets to name their price, functioning under a completely different set of economic rules. Accumulating real wealth rarely requires you to be the smartest innovator in the room. It requires you to step away from the crowded battlefield and play an economic game where the rules are quietly rigged in your favor. This brings us to the core engine of predictable wealth. Let's call it the popsicle principle. This flow model shows what happens when you sell a single popsicle. You expend your sweat and effort one time, and you generate a single revenue output. The transaction hits a dead end, and tomorrow you start from zero. But watch what happens to the timeline when you buy the popsicle cart and rent it to someone else. You absorb a single upfront cost, and in return, you generate a continuous loop of automated monthly income. This structural shift is called recurring revenue. It completely severs the link between your daily physical labor and the financial transaction itself. A skilled strategist understands that inventing a better product is a trap. The actual objective is to own a system that facilitates automated, repeating transactions. The first way to build that system is through the B2B automatic contract, a model perfectly illustrated by services like commercial pest control or bookkeeping. These businesses operate on an incredibly powerful psychological trigger: compliance. A restaurant owner signs a monthly pest control contract because they are terrified of failing a health inspection, just like they pay a bookkeeper to avoid an IRS audit. Take a look at this chart tracking client profitability. In month 1, your margins are low because of the initial cost to acquire the customer. But from month 2 to 12, that acquisition cost drops to absolute zero, allowing your profit margins to expand on the exact same client. This dynamic completely flips traditional sales on its head. The business owner no longer has to convince people to buy something they don't really need. Instead, they simply focus on providing basic maintenance and collecting the recurring checks. Anchoring your income to a client's fear of operational collapse creates a financial fortress. When the economy dips, these are the absolute last expenses a company will ever cut. The second mechanism relies on physical infrastructure, the reusable asset. This includes unsexy items like portable toilets, ATMs, and vending machines. The logic here is straightforward. You take on the painful, upfront capital cost of buying the machine once. By absorbing that initial burden, you earn the right to charge dozens, even hundreds of people, tiny fees for temporary access. This schematic illustrates the concept of invisible real estate. Dropping an ATM or a vending machine onto a mathematically worthless patch of carpet instantly transforms it into a highly active profit center. Building massive wealth is rarely about selling people the lifestyle they desire. It is about quietly owning the invisible, everyday infrastructure that facilitates their normal lives. But there is a final strategic shortcut that bypasses the hardest part entirely. You do not need to build a recurring revenue machine from scratch. You can simply buy one that already works. Consider Alex. He wanted financial independence, but completely avoided the chaotic startup phase. Instead, he took out a business loan and purchased a local laundromat that had been running continuously in his city for 15 years. The math on this decision changes the entire risk equation. Paying a premium to acquire proven historical cash flow and an existing customer base is a lower risk move than betting capital on future unproven sales. At the highest levels, financial strategists do not view themselves as inventors. They see themselves purely as capital allocators, hunting for optimized cash flow systems to acquire. So when we talk about a boring business, we have to strip away the negative connotation. It doesn't mean dull or formal. In a financial context, boring strictly means repeatable, which gives you the ultimate filter for evaluating any opportunity you encounter from this point forward. You only have to ask one question: will this pay me once, or will this pay me every single month? Because lasting financial freedom is never achieved through fleeting moments of excitement. It is built through relentless, unglamorous, mathematical consistency.